EduTrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your EduTrainer National Insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant. I'm the National Insurance columnist, and I'm the host for the Business Insurance Zone. And I'm your EduTrainer today on the entry level for life insurance, brought to you by Lincoln Benefit Life, one of our subsidiaries of Allstate. And I just wanted to talk to you a little bit about today the Eclipse software from Lincoln Benefit Life. Again, we voted this as the most user-friendly software for life insurance illustrations. And so I want you to go out to www.lblsales.com/ETW so that you can go and download the software, because in the weeks to come, we want you to be able to participate with us. We're going to say, go ahead and upload your Lincoln Benefit software so you can go page by page. And many of you can minimize your screen, park it on one of the sides of the computer, keep your illustration open so you can do the same thing I'm doing. I'll be going through a real methodical teaching using their software so that you can enter. Now, a lot of people are entering our business because people are coming in from property casualty, medical field, securities. There's all types of, even banking, coming into our practice and our business, so they want to learn about life insurance. What I'm trying to do is give you an introduction into life insurance. Over the next 3 months, we're going to be doing a complete entry-level education. Now, before I get going though, if you remember, if you were with us in yesterday's class, I was just stretching your mind a little bit, trying to open your head to some of the ideas behind life insurance. And I was using a little bit of fun math with it. And yesterday, if you remember, I was teaching basically how to do 85 squared in your head. And if you recall, yesterday I said if you did 5 times 5, and then 8 times 8, which is 64, plus 8, that would be 72. So the formula is 5 times 5, 8 times 8, plus 8 gets me 72. The total number is 7,225. So I was showing you in your head how to do that. Now I'm going to show you one more step in your head to do the same idea, 85 squared, except this time I want you to do it a little different way. 5 times 5 times 5, 25. What's the next number after 8? The number is 9, 7225. So I'm just showing you different ways. So this week you will have learned the one you already knew how to do, the normal 85 squared, but now you're looking at different numbers. And the reason I'm doing this is to kind of get your mind a little more elastic, to kind of pull apart your thinking and adopt some of the ideas that we're talking about. So when we're looking at it, I want to be able to talk about some of the things that we're doing. And today we're talking about income. Yesterday we talked about indemnification. Today we're talking about income. The primary tool of life insurance and its benefit is the death benefit scenario or the coverage scenario. However, it has a secondary advantage and a benefit, and that is it has income possibilities with a permanent contract. Now remember, on term insurance, there is no cash values, hardly at all. There's some conversion credits. I'll get into that a couple weeks from now, but really there's no cash. Cash values that accumulate can also not only accumulate, but you can take it out as income. Now, it's really interesting to note that in income scenarios with life insurance, there are tax advantages. And those tax advantages can be huge. And some of the ways we can take our cash value accumulation out is by withdrawals, just withdrawing the money, generally basis. Again, we'll get into all that coming up. Policy loans, and annuitization. Huge tax advantages because when I take policy loans out and I keep the contract in force, in fact, actually, let's do that first. My disclaimer on all this is, if I purchased a contract that was compliant with the TAMR regs under non-modified endowment contracts, and we're going to get into all that, so don't worry about it now. It's called non-MEC, but the actual phrase is modified endowment contract. If I have a non-modified endowment contract, I may be able to take out tax-advantaged income, and that tax-favored position of taking out withdrawals, and in my case specifically, basis. And basis is your money that you put into it. What did you contribute? That becomes your basis. What did you give, contribute? What did you donate? How did you fund the life insurance contract? When that I fund it, I can take my funds out, depending upon what year I take it out, and we'll have to get into that a little later as well. I might be able to take my withdrawals of basis out free, depending upon when I do it. Policy loans are loans against the contract. Once I'm done with withdrawals to basis, I may want to start taking my gains out without paying taxes. To do that, I'm going to have policy loans. Now remember, policy loans have charges. Later on in our workshops, we're going to discuss policy loans, and we're going to manage it into the ground and say all the possibilities, whether it's variable or fixed, whether it's zero net cost loans, spread loans, wash loans, or even direct recognition loans, or if you're doing indexed UL, even the arbitrage loans or these participating loans that they let you do. One of the cool things about income, supplemental income with life insurance, is the tax advantages. For example, if I'm strategic, I keep the policy in force for the life of the insured, and I make sure that I'm a non-modified endowment contract. Again, we're going to get into all that later on. I'll be able to pull my money out tax-free. And unlike other tax-free instruments, I do not have to pay any tax. And some taxable events, like I'm thinking of a basic municipal bond, generally, if it's a federal or a state or municipality, you may not have to pay any tax on any of those areas. However, some municipal bonds actually could be subject to the alternative minimum tax, and they're all counted for your taxation on Social Security. So when I'm weighing in, what's the difference between life insurance tax-free, which could be the potential depending upon how we do this, and again, we're going to get into all that in the coming weeks, but I'm also going to measure, well, how was the impact? I bought municipal bonds because I knew there were tax advantages to it. But if my actual income from my municipal bonds causes something else to be taxed just because it's income, then I'd say, well, is that better than the income I'd get off life insurance? Another example of this is basic capital gain treatment. As you know, a lot of people want capital gain taxes because it's less than ordinary income tax. Capital gain, I might pay 15% on my gain, but the full amount of my income is used for the provisional income test for Social Security. So even though the tax is less, I'm still paying taxes on my Social Security. It may trigger that tax in the provisional income test for Social Security. So when I say tax advantage of life insurance, none of these issues are going to happen. I'm not going to have the same issues with capital gain treatment as it relates to Social Security, being part of the calculation for the benefits. I'm not going to have to worry about municipal bonds. Some of them may or may not be subject to the provisional income test or the AMT. There's a lot of really things that you want to look at, and that's why I'm looking at these three structures so that you can understand this is tax advantaged. It's tax favored. And these tax advantages can be a secondary reason why you have the insurance. The first part of my insurance is always built on indemnification. But the second time, especially if being permanent, can I get some advantages from income? I always love to fund my qualified plans when my employer's matching my contribution. That's a great deal. But sometimes I'm looking at also secondary places to put money away for retirement or maybe for college or for long-term savings. I can use life insurance, have my coverage, and I might be able to get some income out of it. So cash value accumulation is huge, and the ability to pull it out tax-free are some of the great leverages of this. Now, you can do this as a personal or an individual or your family, but you could also do it for business. So businesses may look at this as, I'd like to be able to give one of my key employees an idea to keep him around and give him a benefit like retirement income. As an example, I might want to do key man or woman, and I might want to give them an extra perk, not only life insurance for a death benefit scenario, which I'm sure they'll enjoy, but I might want to be able to give them something that has a tax-advantaged income scenario. That word is advantage or favored. And they may say, wow, that's a great deal. That's part of my recruitment. That's part of my employee retention. I'm going to give my key man or key woman a tax-favored income scenario so that they can really enjoy working for me because they see that I'm actually contributing. And because it's key man, in this scenario, we're not under ERISA. We're actually non-qualified, so we can be discriminatory. That's why a lot of people not only use key for key man or key woman, but they might want to do something as an executive bonus. So in business, when we're talking basic ideas of income, and again, we're going to get into this all throughout the workshops over the next couple months, executive bonus, these arrangements can be huge for recruiting employees and retaining employees. That's why it's important to know that tax-advantaged income or tax-favored income, the treatment is so great because if it's done correctly, our income off life insurance shouldn't appear on your 1040. Now remember, you can also not only withdraw or take loans out, but I also mentioned a third thing that you can do, and that's called annuitization. And I could take my cash values for my income, and I could annuitize it, maybe for the life of the insured, maybe for a 20-year certain period, perhaps a 10-year period. Now, when I annuitize, I'm now leaving my death benefit behind. So that's why some people say, oh, I don't ever want to annuitize this. But if you look at the annuitization rates, depending upon when the contract was written, I always like to look at withdrawals to basis, policy loans of gain. I want to look at the cost of those policy loans, and I might, depending upon the client's tax bracket and their long-term goals, I might look at annuitization. Again, I lose the death benefit, and remember, some of this has tax advantages, but ultimately the gain in the contract, if I annuitize, could be subject to full ordinary income tax. The advantage of deferral is great, but I won't ultimately get the tax-free that I might get with withdrawals to basis, policy loans to gain, or other forms of loans that we take out of policy. So I'm looking at annuitization as another basic idea. Think of annuitization as a mortgage. I'm reversing how I think about a mortgage. I pay into a mortgage. I have a $500,000 mortgage. I'm paying every month to pay it off. I have to pay interest, and by the time I'm done with my interest, I might be paying, instead of $500,000 for that, and these days rates, I might be paying twice the amount for my mortgage because I'm paying increments payments. In annuitization, I'm doing the same thing in reverse. I'm receiving payments to myself, and remember, depending upon the tax treatment we do the annuitization, there's going to be money coming in to me, and I could elect a life option. I could elect a 20-year, where I just want to have to pay for 20 years in that, or 10 years. Just remember, heads up, when I do annuitization, I'm going to be handing the death benefit, kind of those proceeds are going to be gone once I trigger this. So people are kind of reluctant to use annuitization in this regard because they lose the death benefit. But sometimes I have to look at annuitization because it actually is the better deal as long as I'm not needing the actual death benefit. So I have tax advantages, there's tax favoredness, and we're going to break this all out over the next couple months. And we're going to look at all these ideas for income so that you can generate tax. There's taxable income, there's tax deferred income, and there's tax-free income. And we're going to look at all three as they relate to life insurance. All the taxable income or deferred income, which will ultimately be taxable, will be in the ordinary income tax range. So you always say, what kind of treatment will it get? It will always be ordinary income tax. And remember, in our culture, we're in what's called a blended marginal bracket. They step up, but nobody pays the step up. It's a blended tax bracket. And I'll have sheets on that so that you can always figure out, what's my blended tax bracket? Is it a good deal or a bad deal based on what I have to pay ordinary income taxes on? So when I look at it, it could be tax-free, it could be tax-deferred, it could be actually taxable, just depending upon what. That's tax-advantaged income using life insurance.
This has been an EduTrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.